Today I'm going to talk to you about business structures. Different structures have different outcomes, so it's important to get it right. If you embark on a business venture with others, what ownership structure should you use? The main structures used by business ventures are partnerships, unit trusts and companies. Which is the best for you? It's an important question because if you get it wrong, then you could risk your assets unnecessarily. You could be paying too much tax, impede your growth and cause problems in succession planning. Common ownership structures are companies, partnerships and trusts. The nature of partnerships and companies is commonly understood, but trusts less so. Trusts are entities that hold property for the benefit of others. A trustee, usually a company, holds assets on behalf of the beneficiaries. So commonly, discretionary trusts are established for a family, and a trustee has discretion as to which family member or family entity benefits from the trust income or capital. The other common trust is a unit trust, where unit holders have fixed entitlements to the trust income and the trust property. In this case, there's no discretion in the unit trust. Identifying the differences between the structures will help sort out which structure is right for your venture. Let's differentiate the character of partnerships of trusts, partnerships of individuals, companies and unit trusts by considering asset protection, the treatment of tax losses, access to small business CGT concessions, income and the taxation of capital gains. Getting asset protection right from the beginning might be the best decision of the whole venture. Right from the start, I'd like to make two key statements. One, in my view, there is no perfect asset protection structure, so don't be deluded. And two, as a general statement, a structure with a discretionary trust will provide the best protection of assets because there's a separation between you and the assets held on your behalf. So if you're sued, the trust assets are not your personal assets, they're held elsewhere. Compare that to a company in which you own shares. If you're sued, the value of the company is exposed because your personal assets include the shares. I also want to say something about partnerships of individuals. If you're in a partnership of individuals, you're jointly and severally liable to each other. The risk is too much. Forget it. Don't do it. I'm not going to talk about partnerships of individuals anymore. If you need more convincing, then give me a call. Now, in a company structure, shareholder risk is limited because the business is owned and conducted separately by the company, although directors are exposed in certain circumstances. And remember, personally owning shares exposes the value of the shares to personal litigation and creditors. A unit trust is similar to a company. The business assets are held separately, but if you hold the units personally, the value of the units is exposed. Now, a partnership of discretionary trusts is more interesting. Yes, the discretionary trust partners share the partnership liabilities, but if the only asset in each trust are the business assets, then you have isolated the business risk from your non-business assets. The trust structure also separates the business assets from you personally. There are no shares or units or even future income streams that are exposed to litigation or creditors' claims. So now let's look at tax losses. In a partnership of trusts, any tax losses will be available to each discretionary trust because each partner is engaged in the business. But in a company, tax losses will be trapped in the structure. The shareholders will not access the losses. Furthermore, the losses are subject to various loss recruitment rules, so you'll need to be aware of what's going on there. Unit trusts are the worst. Losses are either trapped or simply lost in some circumstances. Next on the list was the small business CGT concessions. One of the requirements to access those generous concessions is that your net business and investment assets are less than $6 million. Now, with a partnership of trusts, each discretionary trust is a business participant, so each trust is tested for eligibility separately. That makes it generally easier for a partner to satisfy the $6 million test than with other structures. So with a company structure and a unit trust structure, the concessions are not available if someone owns less than 20%. This is not the case with a partnership. Also, beware. Some of the concessions require the structure to be liquidated in order to get the full benefit of the concessions. Liquidation can trigger other tax liabilities. So the treatment of income is quite different between the different structures. Fundamentally, trusts and partnerships allow owners to get pre-tax profits, and that's very useful. This owner might have losses, but this one not. Partnerships and discretionary trusts enable income sharing flexibility. In a company structure, the company will pay tax on profits. It's no effort to retain profits in companies, but with trusts, it's more complicated. Profits that are not paid out are taxed at the highest marginal tax rate in trusts. If the profits are needed to fund the business, the profits need to be lent back to the trust. Let's turn to capital gains. Trusts can reduce a taxable capital gain by 50% if the trust distributes the gain to an individual. Companies cannot reduce a capital gain at all. A company pays tax on a capital gain the same as it pays tax on income. This is a key difference. So there we have it, different outcomes depending on your choice of business structure. Of course, it's also the case that the more sophisticated your structure is, the greater the cost of establishment and management. Be informed and choose carefully. We didn't have the time in this video to explore combinations, for example, ownership of companies and unit trusts by discretionary trusts, but that's another conversation.
We've drawn up a sticky note containing the essential details, which you can access from our website at www.cfmc.com.au. Just click on the publications link on our homepage or call us for an obligation-free consultation. We'd be happy to help you with any questions you might have.